on your way to meeting your match. 4 out of 5 employers who post on ZipRecruiter get a quality candidate within the first day. So try it now. Go to ZipRecruiter.com/free. Once again, that's ZipRecruiter.com/free.
Meet your match on ZipRecruiter. Try it free.
You still thinking job change in the new year?
Yeah, I need something that's in high demand and more stable in this economy.
IT?
Yeah, cybersecurity, maybe even AI.
That's what I did.
Really? How?
Went to My Computer Career. You don't need any prior experience. You could start a new career in a matter of months. A lot of IT pros go to school there too to level up.
Sweet. Are classes online or on campus?
Both.
Wow, I'll check it out. Thanks.
Make this your year. Take the free career evaluation now at mycomputercareer.edu, an Elite CompTIA certification partner.
Financial aid is available to those who qualify, including VA benefits.
Individuals and businesses with tax problems, listen carefully. If you owe over $10,000 in back taxes or have unfiled tax returns, U.S. Tax Shield can help you take back control. The IRS can seize your bank accounts, garnish your paycheck, close your business, and file criminal charges. Our team of tax attorneys can stop collections and get you protected. U.S. Tax Shield offers a price protection guaranteed quote to get you protected today. U.S. Tax Shield is A+ rated with the BBB, so call 800-466-9625. U.S. Tax Shield, 800-466-9625.
You're tuned in to Money Matters Boston, 1120 AM WBNW. This is WBNW, 1120 AM, the Money Matters Radio Network. This is the Money Matters Radio Network, WBNW 1120 AM and W275CM FM. Concord, Boston, the Money Matters Radio Network. If you've been dreaming about a getaway that feels far away, but easy to get to, it's time to think about the U.S. Virgin Islands, America's Caribbean. This is a place where you can fall naturally in rhythm with the heartbeat of the islands. Enjoy crystal clear water and powder soft beaches, world-class dining, sailing, and unforgettable sunsets. And here's the best part. Travel from New England is easy. The U.S. Virgin Islands are part of the United States, which means no passport required and no money to exchange. Just pack your bags and go. Spend your day snorkeling, sailing, hiking, or simply relaxing by the water, and your evenings enjoying local cuisine, live music, and warm island breezes. Explore St. Thomas, St. John, and St. Croix, 3 distinct islands, each with its own vibe, its own flavor, and its own way of helping you unplug and reset. Start planning your Caribbean escape today and visit usvi.com. Discover why the U.S. Virgin Islands are America's Caribbean paradise. For more information and to book your trip, head to visitusvi.com. That's visitusvi.com.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We pride ourselves on being able to support veterans in their time of greatest need, ensuring they receive the protections they deserve. For over 100 years, the DAV of Massachusetts has helped thousands of veterans with housing, transportation, and medical assistance, and you can help too. Please visit dav5k.boston and make a donation today. That's dav5k.boston.
Are you over the age of 50? Want peace of mind and financial security for your family? Here's an important message to you from Senior Care USA. The average funeral now costs over $10,000. That leaves your loved ones the burden of paying your debts and funeral costs. Our plans start as low as $1 per day and will pay your family up to $30,000 to help pay for your funeral and other expenses. There are no medical exams. Your rates will never increase, and your plan cannot be canceled, regardless of your medical condition, as long as you make your premium payments. Get up to $30,000 in final expense insurance. Call now for free information. Just answer a few simple questions and get approved right over the phone in just a few minutes. Call right now.
Call 800-378-3818. 800-378-3818. 800-378-3818. That's 800-378-3818.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and we have a guide available this month titled How to Apply for Social Security and Medicare. Mike, one of the many questions that people have as it relates to Social Security and Medicare is, what's the difference in terms of how much I earn based on when I apply?
Yeah, and there's plenty of confusion around all of this because The ages have changed over the years as we've made reforms to the Social Security program, and there's different ages for Medicare and Social Security. So first things first, for vast majority of folks now, 67 is the current full retirement age for Social Security, whereas 65 is the eligibility age for Medicare, and then you scale up or down your benefits depending on how much earlier or later you claim when it comes to Social Security.
An important thing to note, you don't have a do-over on this. Basically, when you claim Social Security, that is what you are locking yourself into. The programs where you used to be able to adjust that, they haven't been around for a while now.
No, and so, for example, if you end up claiming your benefit at 62, in addition to having penalties for how much you get in earned income, you're going to be collecting about 30% less than your full retirement benefit, whereas if you wait all the way until age 70, you'll be collecting about 124% of that full retirement age benefit.
Our guide is titled How to Apply for Social Security and Medicare, and there are two ways that you can request it. The first is by calling 800-393-4001. The second is by going to ArmstrongAdvisory.com. That number again is 800-393-4001, or you can request it at ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Paul Lane and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Paul Lane and Marc Fandetti.
Welcome to this Wednesday edition of the Financial Exchange. Paul Lane, Tucker Silva, and Marc Fandetti here with you as we dive into a very busy show and an important week and a half or so for the U.S. economy, as we will get several different economic reports to digest over the next few days and some early next week as well. The focus for this week is largely the labor market. That has been the biggest concern of the Federal Reserve. The story last year was the announcement of tariffs precipitated a lot of concerns about rising inflation and increased costs across the economy. Those largely haven't bared out just yet, and so as a result, you've seen the Federal Reserve shift its focus more largely to the employment market. We see the unemployment rate as of last month's jobs report sitting about 4.6%. We will get another jobs report this Friday. Well, we will get another read on the unemployment rate for the month of December. And we did get several labor reports today that we'll go into. We're going to start right off the bat. ADP, which is a private service that reports payroll data, noted that private payrolls rose 41,000 in the month of December. That was slightly below expectations, which I believe that they had projected for about 48,000 jobs to be added for the month of December. In November, that was a negative number. We had a loss of about 29,000. So it's important to note with the ADP data, it's not something that is focused on as significantly as the Bureau of Labor Statistics report that is going to come out on Friday, but it is something that you do take into account with some of these other economic data pieces out here. And we also had a JOLTS report that just came out moments ago. This is the job openings and labor turnover survey, and that one seemed to be a relatively low reading, and we're going to have to break this down a little bit more as the show progresses because it did just come out within the last few minutes. But now we sit from November's data again, this is a little bit backwards looking how they do these JOLTS reports with 7.15 million job openings. That was well below estimates of 7.65 million jobs. So that is a pretty significant drop-off. If you look back at the JOLTS reports and the job openings over the course of the last 5 years or so, we hit our peak back in March of 2022 where there was about 12 million jobs available in March of 2022. Since then, it's trended downward. I don't want to make it seem as if this is, a huge area of concern, that 12 million to 7.5 or 7.15 million drop off, because that was a true peak in the labor market in March of 22 when we hit that 3.5% unemployment rate. But still, market has been trending to have less job openings, and another sort of kernel of data that is somewhat pessimistic about the direction the labor market could be going in 2026.
Yeah, JOLTS has received a lot of attention because it became a better forecaster of inflation than the traditional measure of slack in the economy, which is the unemployment rate. So if you're an economic forecaster, JOLTS has been more useful over the past really couple of decades than the unemployment rate as an indicator of whether the Fed is over or understimulating or getting things just right. Unemployment is a measure of slack in the economy. It's a measure of how healthy demand is. So the Fed pays a lot of attention to measures of slack in the labor market, historically unemployment, more recently JOLTS. You mentioned that the number of job openings fell from the original October number. Paul was about 7.6 and change million.
Right.
That means businesses were advertising for about, I'm going to round up, businesses were advertising for about 7.7 million positions. The number reported this morning was 7.14 million. I can't really round that up. You know the rule. If it's greater than a 5, you round it up. So I'm not going to round this up. I'm going to call it 7.1. So it looks like 600 million job openings just disappeared. But in fact, October got revised down.
Yep.
Looks like it's 7.449 million is the actual. It was originally reported at 7, as I mentioned, 0.670 million. So there goes a couple hundred thousand, job openings into thin air because they never existed. So nevertheless, the number of advertised positions, so-called job openings, has dropped a lot from its peak. At its peak, it was 0.1 million. Now it's 7.1 million. One way to make sense of it is to take the ratio of number of people looking for jobs or the unemployment rate, take the number of job openings, now 7.1, to the ratio of the number of people looking for jobs, which is just the unemployment level, the same level that we used to derive, that we used to calculate the unemployment rate. That level is now below 1. It's the quotient is 7.1 divided by 7.0. I'm just going to call that 0.9. And
how many unemployed? On the
7.8 is the unemployment level.
Yep.
7.8 million people looking for work. So the stat that comes from JOLTS that receives a lot of attention is that supply to that demand for workers relative to supply. That ratio was well over 2 in early 2022 when the economy was. Everybody agrees now overheating due to too much stimulus and the opening up of the economy following the COVID lockdowns. We're now back to that ratio. Now is back to something closer to the late 2010s.
Yep.
Still higher though, much higher than its historical value. I don't know that that's a good reference point. I don't know that the right ratio of openings to unemployed people is 0.75, and by right I mean non-inflationary. So this is good news, I guess, if you're looking for downward pressure on inflation. Bad news if you fear that the labor market is cooling too fast.
Right.
I don't know what to make of it. The labor market was so unnaturally hot a few years ago. And we saw the inflationary consequences, right?
Yeah, it seems like it reset all expectations a little bit. It's hard to do it justice when you're looking back at these 5-year figures. You mentioned the 12 million of openings. I mean, that was a once in a 100-year shock that we were dealing with, where the economy shut down and then reopened, and that's why you had just a flood of jobs on the market. And now the data looks more similar, like you were saying, to the late 2010s numbers that we had seen in terms of the job openings out there. But I want to hit that point that you made again, because I think it is important. Right now, according to the survey, 7.14 million jobs available to 7.8 looking for jobs in terms of the unemployment level.
The unemployment level, right? Right.
So that's just something that is worth focusing on. That level was a much higher ratio when you had 12 million jobs available to those looking for jobs out there. So again, this is the big focus. I think for 2026, it would be one of the headline pieces to look at is the labor market. And I'm not saying that the JOLTS is the end-all, be-all.
I wasn't going to disagree. I don't know if it's still the right Slack variable. That's what a Slack variable sounds technical. It just means the measure that an economist would use to measure slack in the economy. So I guess it is pretty self-explanatory. It might be the unemployment rate now is a better predictor of inflationary pressures. Either way, both these things, I guess we should sum up by pointing out that both these things are pointing in the same direction. There's more slack now in the economy than a year and 2 years ago, certainly.
Yes.
I just don't know if that means the Fed needs to goose demand, which they have decided is the right course, or this is a welcome normalization. Inflation has slowed. Labor market's kind of getting back to normal. 4.6% unemployment, historically speaking, is awesome.
Mm-hmm.
That may sound flip, because if you're looking for a job and you're hearing me say that, you say, well, it's not awesome to me, jerk. But it is pretty good. So we have to talk in terms of averages here. We can't address everybody's situation. That's pretty darn good, historically speaking. We know GDP growth was awesome in the second and third quarter. If you average those 2 quarters, we're not talking about GDP right now, but it's lurking in the background. You can't avoid it. We're talking about 4% real GDP growth. I'm dropping the first quarter, which was terrible, but last 2 quarters have been pretty good.
For context, for listeners out there, 4%, 2% is sort of the average that we run on. To see that 4% number is pretty tremendous.
It's, by the way, unsustainably awesome. I
Right.
should have added that. I'm not really excited about it because I think it's sustainable. It actually worries me a little bit because it's clearly not sustainable. The supply side of the economy is not growing fast enough to support growth of 4%. Unless there's some AI miracle going on that we can't measure more specifically yet, and it's just showing up somehow in GDP and productivity too. Very, very possible.
Yeah, there certainly is just a lot of interesting indicators out there. Like you mentioned on the labor front, it does seem like there is a bit of slowing here. In terms of market reaction, there really isn't a tremendous amount to this data that we see today. I think there will be far more focus on the Bureau of Labor Statistics report that is going to come out on Friday. Right now, you have the Dow Jones off about 200 points or close to 0.5%, and the S&P 500 is barely budging here. So we're going to take a quick break here on the Financial Exchange, and when we come back, we're going to be covering AI fatigue, leaving investors focusing on companies outside of that Magnificent Seven. We're going to talk about that and much more right after this break here on the Financial Exchange. Stick with us.
Breaking business and financial news first throughout the day. Only here on the Financial Exchange Radio Network. When a loved one needs a nursing home, decisions need to be made quickly. If you haven't started planning yet, get Cushing & Dolan's new guide called Long-Term Care Planning for Procrastinators. In it, you'll learn how to make smart decisions and avoid unnecessary expenses. Call 866-848-5699 to get your free guide today. That's 866-848-5699. Or request it online at LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, I'm Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts provides thousands of hours of voluntary services at our VA medical centers and soldiers' homes and is the only DAV department in the country to lead a veterans housing initiative for both single veterans and those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
If you've been dreaming about a getaway that feels far away but easy to get to, it's time to think about the U.S. Virgin Islands, America's Caribbean. This is a place where you can fall naturally in rhythm with the heartbeat of the islands. Enjoy crystal clear water and powder-soft beaches, world-class dining, sailing, and unforgettable sunsets. And here's the best part. Travel from New England is easy. The U.S. Virgin Islands are part of the United States, which means no passport required and no money to exchange. Just pack your bags and go. Spend your day snorkeling, sailing, hiking, or simply relaxing by the water, and your evenings enjoying local cuisine, live music, and warm island breezes. Explore St. Thomas, St. John, and St. Croix, 3 distinct islands, each with its own vibe, its own flavor, and its own way of helping you unplug and reset. Start planning your Caribbean escape today and visit usvi.com. Discover why the U.S. Virgin Islands are America's Caribbean paradise. For more information and to book your trip, head to visitusvi.com. That's visitusvi.com.
Social Security and Medicare are oftentimes lumped together, but may be handled separately. And depending on your strategy, they could shape your entire retirement plan. Hi, this is Mike Armstrong from the Armstrong Advisory Group. Choosing when to start Social Security has many effects, including determining the amount of guaranteed income you receive each month. Medicare decisions go beyond coverage as they can impact premiums, out-of-pocket costs, and access to providers throughout retirement. Our new guide is called How to Apply for Social Security and Medicare. It will help you learn how these decisions may fit together and how to take the right steps at the right time to build a secure retirement plan. Call us at 800-393-4001 to get your copy of How to Apply for Social Security and Medicare. That's 800-393-4001, or you can request it online from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Did you outgrow your timeshare and now you want out? But you can't. You can't sell it, and you can't get out of the contract. Imagine trying to get out of your mortgage. That's what a timeshare is. You can't just call up the bank and say, I don't want to pay it anymore. But we may be able to help you do just that. Listen, a timeshare maybe for you once was a great thing, but now you don't use it much. And they are not easy to get rid of. Plus, you do have to pay for it every month. Qualified timeshare owners can get out of their contract legally and permanently without ruining your credit or even filing bankruptcy. And imagine no more mortgage payment or fees. Call the Timeshare Exit Hotline qualification line now. It's free to learn more.
800-455-7967. 800-455-7967. 800-455-7967. That's 800-455-7967. Paid for by Timeshare Defense.
Text us 617-362-1385 with your comments and questions about today's show, and let us know what you think about the stories we're covering. This is the Financial Exchange Radio Network.
This segment of the Financial Exchange is brought to you by the U.S. Virgin Islands Department of Tourism. Experience America's Caribbean and fall naturally in rhythm with the heartbeat of the islands while enjoying incredible beaches, world-class cuisine, and unforgettable sunsets. The weather is perfect all year round, so head to visit usvi.com and book your trip to St. Croix, St. Thomas, or St. John. Enjoy one or all three and enjoy the vacation of a lifetime. The USVI is America's Caribbean paradise. Plan your winter escape now at visitusvi.com. That's visitusvi.com.
The S&P 500 has achieved a cumulative gain of about close to 80% over the course of the last 3 years, and largely a significant portion of that 78% cumulative gain has come off the backs of the quote-unquote Magnificent Seven, which encompasses a lot of the companies that we talk about quite frequently on the show and that have the largest weighting within the S&P 500. NVIDIA, Microsoft, Amazon, Facebook, Google, etc. Those are the companies that have contributed a tremendous amount to the gains that we've seen in the stock market over the last few years. There's a piece here in Bloomberg that is titled AI Fatigue Leaves Investors Focusing on the S&P 500's other 493 stocks away from the Magnificent Seven. If you look at the earnings growth that we've seen from the S&P 500, the Magnificent Seven that I was mentioning before is a huge contributor to the earnings growth that we've seen there. If we were to strip out the earnings growth of those big names, it would be a far worse picture in terms of what we've seen from the other 493 companies. To me, this piece goes into this idea that you should focus on the other 493. Perhaps you could focus on the other 493, but to me, this year And at least the story for this year is still going to be the momentum from those 7 companies. I just don't see how you have a year where they perform poorly and the other 493 pick us up, and we have a good year for the market.
The problem with that argument, well, if you strip out the best performers, everything else stinks. The problem with that argument, and journalists make it a lot, an economist would say that's partial. I'll use a fancy term. I don't mean to sound highfalutin because I barely understand it myself. That's partial equilibrium thinking. You can't just take a slice of the economy, change that, and then put it back in, and then resum everything.
Right.
Because the other parts would have changed. So suppose there was less investment in AI over the last 5 years, leading to less fast earnings growth from AI and AI adjacent stocks. Where would that investment have gone instead? It would have gone into other sectors.
Right.
There would have been innovations elsewhere, not AI, but innovations elsewhere. That would have propelled the earnings of those companies. That investment would have, so there would have been growth elsewhere. That sentence, and you see that repeated a lot. Take these companies out and the S&P stinks. No, you can't just remove a slice of something.
Right.
It's like these movies about time travel. You change one thing. They finally caught on to the fact if you change one thing, you change everything. So you need an alternate universe just to make everything make sense. And now you've got this genre of multiverses. You can't just change one thing about the economy and then slide it back in and then measure the whole again.
Yeah.
That's why I don't like, I'm sorry, I'm digressing on this point, but that's why I don't like that reasoning. It just occurred to me why that's flawed.
No, I don't particularly enjoy it.
You weren't
either.
espousing it, by the way. I'm criticizing what's in the article.
It's I just don't think that's the way to focus on investing, is this idea that, hey, these companies have performed significantly well. This idea of making a case for the other 493, to me, that's not really an approach that makes a whole lot of sense.
You made the point that if those tank, like, I think what you were saying, I'm going to put words in your mouth, like, make the case to me that everything else is going to go gangbusters when those tank.
Yeah.
Like, those tank, we're kind of up a creek without a paddle,
absolutely.
aren't we?
To me, if there's no, I would be shocked to see a year where those big 7 tank and somehow we come out with positive market performance. I mean, the size of them alone, you're talking about close to 35% of the weighting of the S&P 500 from those big 7 right there. So it would be very difficult for the other 65% to counterbalance any negative declines there. I could certainly see a story where the whole 500 goes down because unemployment, gets out of control. But obviously, when you're doing any of these kind of projections, and there's a couple pieces that we'll cover in the stack today, nobody really knows. But again, when you look at the S&P 500, I'm in agreement with you. It's not something that you can just focus on. Well, if you take out 7, this is the deal. You got to focus on the whole thing, for good or for bad, all of it. Venezuela is going to give the U.S. up to $50 million.
Wait, give? sorry to jump in.
I'm just covering the Wall Street Journal headlines
I'm not going to shoot the messenger. Interesting choice of verb.
They're going to provide 50 million barrels of oil to the United States. This is about an approximate value based on the heavy crude that we would be taking from giving, receiving, whatever verb you want to use
as a gift
from Venezuela, is a market value of about $2 billion. Venezuela produces a heavier crude than what is produced here domestically in the United States. That's about as far as I'll go in terms of my knowledge on crude and refinery processes. But it does set up for a situation where, to me, and again, energy prices are these one area that is a fool's errand to try and project also, in addition to interest rates and some of the other economic variables out there. But it seems like, Mark, that you're going to have a tremendous amount of bump. And I'm not saying this incident alone really changes the forecast for 2026, but it seems like there's going to continue to be a surplus of energy, whether you look at OPEC in its increasing supply and non-OPEC as well. It seems like there will be a lot of surplus. So from a strategic standpoint, I just don't understand why this oil is such a huge focus. Don't get me wrong, I understand the importance of it, but it's not like we're talking about the 70s where the U.S. doesn't produce 14 or 15 million barrels a day.
Right?
Yeah. So the strategic standpoint on this maneuver, I don't really understand the focus behind it. One of the things that popped in my head is maybe this is the best way to try and keep inflation down under the control of the political environment.
I'll say, again, it depends on what happens elsewhere in the economy.
Right.
50 million, your point, I should be well taken. It's a drop in the bucket relative to the 100 million barrels of oil the world economy consumes every day. I'm not saying it couldn't move the price. I suppose it could. But what's going to happen? What are other producers going to do? If we continue to extract oil from Venezuela, it just sounds crazy to say that. I'm thinking about the state the world is in today, that countries feel like they can do that. And we're only doing it because other countries have done it. Doesn't make it right. But anyway, so this is the world we live in now. You want something, if you're strong enough, you just kind of take it. Different than the world I grew up in, but we play the hand we're dealt. What effect will that have on production? And suppose we decide to do it again in a few months. What effect will that have on production elsewhere? I think
and domestic investment. Yeah, certainly a lot to get into there. We're going to take a quick break here on the Financial Exchange. When we come back, we're going to have Ask Todd. So get all your questions ready for Ask Todd and Todd Lutzke. 888-205-2263. Ask Todd right after this break.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network. If you've been dreaming about a getaway that feels far away but easy to get to, it's time to think about the U.S. Virgin Islands, America's Caribbean. This is a place where you can fall naturally in rhythm with the heartbeat of the islands. Enjoy crystal clear water and powder-soft beaches, world-class dining, sailing, and unforgettable sunsets. And here's the best part. Travel from New England is easy. The U.S. Virgin Islands are part of the United States, which means no passport required and no money to exchange. Just pack your bags and go. Spend your day snorkeling, sailing, hiking, or simply relaxing by the water, and your evenings enjoying local cuisine, live music, and warm island breezes. Explore St. Thomas, St. John, and St. Croix, 3 distinct islands, each with its own vibe, its own flavor, and its own way of helping you unplug and reset. Start planning your Caribbean escape today and visit usvi.com. Discover why the U.S. Virgin Islands are America's Caribbean paradise. For more information and to book your trip, head to visitusvi.com. That's visitusvi.com.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. Retirement comes with a lot of exciting freedom, but also with some permanent decisions. 2 of the most important ones are when to file for Social Security and how to set up your Medicare coverage. Claim Social Security too early and your monthly check may be permanently reduced. Missing Medicare enrollment deadlines might mean significant penalties and gaps in coverage. We have a new guide available called How to Apply for Social Security and Medicare. It breaks down when you can apply, what information you'll need, and how these decisions fit into a smart, coordinated retirement plan. Get your copy today by calling 800-393-4001. That's 800-393-4001, or you can request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
It happens all over Massachusetts. In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
As a busy mom, your life. So to all the moms, the aunts, grandmothers, and amazing women out there doing it all.
Visit GoRedForWomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
This is Tucker Silva, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange quick tip of the day. And we're talking about last-minute nursing home lessons that can help save your assets. What can be done last minute to save your home and your liquid assets when one spouse is entering the nursing home?
So with a married couple, you do have more options than as a single person, but with a married couple, your home is not at risk because the community spouse living in the home is allowed to keep the home. Doesn't matter the value, as long as they're living there, it's not countable and non-lienable. They also give the healthy spouse about $135,000 to keep. It's not a lot when you think of the big picture, but all the rest of the money would be at risk. But at least a quick last-minute way of protecting all those other dollars, all over and above that $135,000, would be to basically transfer the assets, those excess assets, to the community spouse, which, by the way, is not a disqualifying transfer, so no 5-year waiting period. And then once once that community spouse gets those assets, depending on their age, they can buy what is known as a Medicaid qualifying annuity. These are special annuities. They convert the excess assets into an income stream, and then it's no longer an asset, keeping the community spouse over assets. Then the community spouse and the sick spouse are under assets, and they're eligible for Medicaid.
Cushing & Dolan has written a brand new guide, especially for those of you who have put off doing your planning and are now faced with a last-minute nursing home situation. Request this brand new guide from Cushing & Dolan at 866-848-5699. It's called Long-Term Care Planning for Procrastinators. 866-848-5699. Or if you prefer, you can simply go to their website, legalexchangeshow.com, and request it there.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch. A complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Markets are little changed and mixed as investors react to jobs data posted this morning, including the ADP private payrolls report, in addition to the JOLTS report for the latest on job openings. The all-important December jobs report will be released on Friday morning. Right now, the Dow is off by over 0.4% or 219 points. S&P 500 is edging only 2 points higher. NASDAQ is up by about 1/3% or 84 points higher. Russell 2000 down by 0.7%. 10-year Treasury yield down 2 basis points at 4.155%. Crude oil down about 1.5%, trading at $56.32 a barrel. The Financial Times reported that Chevron and Quantum Capital are planning a bid to buy Luke Oil's international assets. If a deal is agreed upon, Chevron and Quantum plan to divvy up the assets between them, valued at $22 billion by Luke Oil. Chevron stock is dipping. Meanwhile, Warner Brothers told shareholders to reject Paramount's amended hostile bid for the company, saying its existing deal with Netflix is stronger. In a letter, Warner's board said Paramount's offer, quote, remains inadequate. Warner stock is up modestly on that news. Elsewhere, shares in GameStop jumping 5% after the video game retailer unveiled its compensation package for CEO Ryan Cohen that included performance objectives to grow the company to $100 billion. And Mobileye shares are up by about 3% after the self-driving systems company said it would buy humanoid robot maker Menti for $900 million. I'm Tucker Silva, and that is Wall Street Watch.
This is Ask Todd on the Financial Exchange Radio Network. If you have an existing estate plan or are in the market for one, Todd Lutzke is here to answer your questions and help you plan for later life. Ask Todd is presented by Cushing & Dolan, serving Massachusetts and New England for more than 35 years, helping families with estate and tax planning, Medicaid planning, and probate law. Visit CushingDolan.com. Now, here's Todd Lutzke.
As is the case every Wednesday here on the Financial Exchange, we are joined by Todd Lutzke from Cushing & Dolan. If you have any questions regarding estate planning, shifting, Medicaid protection, give our studio line a call at 888-205-2263. Again, any of your questions for Todd Lutzke, give our studio line a call at 888-205-2263. Todd, thank you so much for joining us.
Always a pleasure. Thank you.
I would say Happy New Year, but my producer here hates that and says that the time has passed to say Happy New Year on that. So I will not do that to make sure I don't get beaten up by Tucker here.
Well, great. I'm not gonna say Happy New Year either.
All right.
So 2 of us didn't say Happy New Year more than one time.
Moving on. Todd, one big subject that comes up often meeting with clients is long-term care costs and the planning surrounding that. And for some people, it's just too costly to afford a long-term care insurance policy. And it can be a situation where they just fall behind the 8 ball and they find themselves in a situation where they're just not prepared for the long-term care costs that they face. What are some of the suggestions or tips that you have for folks, for those who have not done their planning in terms of long-term care costs? Because it's a big issue around this area, quite expensive.
Yeah, so a couple of things. If you haven't done any long-term care planning, and you're, of course, not not faced with, going into the nursing home anytime soon, then you have time, right, to do some advanced planning and to figure out a way to try to protect some of these assets. And by the way, we're not necessarily poo-pooing long-term care insurance, but you're right, Paul, it can cost a lot of money. And quite frankly, people that are like, when you get to age 70, it's kind of tough. It gets harder and harder to afford it. And again, you never need long-term care insurance to be the end all be all. It can just be, don't have to be a Cadillac policy. It can be a smaller policy that sort of supplements the care. But either way, it's generally never enough to cover $16,000, $17,000 a month. It just isn't. So people, in fact, will say, well, fine, what can I do? Well, that's where these irrevocable Medicaid trusts come in. And I know we spend a lot of time on them over the years, but they truly are, they're really the only way that I know of to protect assets from the nursing home. So many people say, well, isn't there like a ton of options? And I always say, no, it's not like picking paint where you have tons of options. It's really, do nothing, give your assets away to your kids, which is a horrible idea across the board, or do an irrevocable Medicaid trust. So those are really your three options if you want to protect it. And these trusts are really, designed in a way to keep you in control. And I think that's the most important message that I can send to people when I'm talking about irrevocable trusts. In fact, I had one recently, a real life story. We got hired to do the estate plan, and about 2 weeks later, he called back and said, I'm just so afraid of the word irrevocable. And then I had to call him back, and we talked again, and I had to explain to him that you're reading the engagement letter, and it seems scary, but it just needed clarification. And by the time we hung up, he's like, oh yeah, you're right. I'm really not giving up any control, because I explained to him, as I explained to everybody, that, you live in your house, you pay your bills, you sell your house, you buy another house, all through the trust. Very easily done, no effort, no adverse tax consequences. You can also have investment accounts in there now, not IRA accounts, but investment accounts, stocks, bonds, mutual funds. You can manage the money. You can, invest the money the same as you always did. You can live off the income, take it out, enjoy the income, and even pay the taxes on that income at your rates, not at trust rates. People get concerned all the time. They hear, or they go on the website or internet, and they say, my gosh, I read about irrevocable trusts and there's huge income tax problems with them. Well, there can be, but if they're drafted as grantor trusts, then they're not.
Sure.
And everything is taxed at your own rate. So, that's just an overall summary of these irrevocable trusts to let people know that it's really the best way, the only way to actually protect assets and to not really be frightened off by the word irrevocable.
Certainly a lot of nuance to the subject. If you have any questions, we're here with Todd Lutzke from Cushing & Dolan on the estate planning realm or regarding irrevocable trust. Give our studio line a call at 888-205-2263. Again, that studio line number for any of your questions for Todd Lutzke from Cushing & Dolan, 888-205-2263. We're going to take a quick break here, but when we come back, we'll have your questions with Todd right after this break.
Ask Todd with Todd Lutzke every Wednesday at 10:30, only here on the Financial Exchange Radio Network. If you've been dreaming about a getaway that feels far away but easy to get to, it's time to think about the U.S. Virgin Islands, America's Caribbean. This is a place where you can fall naturally in rhythm with the heartbeat of the islands. Enjoy crystal clear water and powder-soft beaches, world-class dining, sailing, and unforgettable sunsets. And here's the best part. Travel from New England is easy. The U.S. Virgin Islands are part of the United States, which means no passport required and no money to exchange. Just pack your bags and go. Spend your day snorkeling, sailing, hiking, or simply relaxing by the water, and your evenings enjoying local cuisine, live music, and warm island breezes. Explore St. Thomas, St. John, and St. Croix, 3 distinct islands, each with its own vibe, its own flavor, and its own way of helping you unplug and reset. Start planning your Caribbean escape today and visit usvi.com. Discover why the U.S. Virgin Islands are America's Caribbean paradise. For more information and to book your trip, head to visitusvi.com. That's visitusvi.com.
Social Security and Medicare are oftentimes lumped together, but may be handled separately, and depending on your strategy, they could shape your entire retirement plan. Hi, this is Mike Armstrong from the Armstrong Advisory Group. Choosing when to start Social Security has many effects, including determining the amount of guaranteed income you receive each month. Medicare decisions go beyond coverage as they can impact premiums, out-of-pocket costs, and access to providers throughout retirement. Our new guide is called How to Apply for Social Security and Medicare. It will help you learn how these decisions may fit together and how to take the right steps at the right time to build a secure retirement plan. Call us at 800-393-4001 to get your copy of How to Apply for Social Security and Medicare. That's 800-393-4001, or you can request it online from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. This is a message for families who've been putting off their estate planning from the elder law attorneys at Cushing & Dolan. One of the biggest myths about long-term care is that if you didn't plan 5 years ahead, you're out of options. That's simply not true. When a health crisis hits and a loved one needs nursing home care, many families panic and start writing checks for care that may cost over $10,000 a month. The reality is, there may still be meaningful legal options available, even when planning starts late. Cushing & Dolan have just released a new guide called Long-Term Care Planning for Procrastinators. It breaks down what the 5-year look-back really means and what steps can still be considered before making decisions that can be incredibly costly. If you're worried about protecting your family and securing your financial future, call Cushing & Dolan at 866-848-5699 to get your free guide today. That's 866-848-5699 or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
You're listening to Ask Todd with Todd Lutzke on the Financial Exchange Radio Network.
We are back here with Todd Lutzke from Cushing & Dolan. If you have any questions regarding gifting, irrevocable trusts, or estate planning, give our studio line a call at 888-205-2263. Again, any of your questions heading into 2026 on estate planning, gifting, irrevocable trusts, give our studio line a call, 888-205-2263. We're going to go to our first caller, Jim, who is in a truck. Jim, you're on with Todd Lutzke.
Hi, Todd. I did an irrevocable trust with you 5 years ago, and I'm past getting past the look-back period, and I come to the realization that my estate isn't as apt to want to deal with the rental properties that are contained within the trust. I have been, and I'm trying to plan my strategy going forward, balancing 1031 exchanges with how do I sell the properties, put it in my IRA, that whole process of moving forward. If I sold the properties, pay the taxes, does that money go into my IRA, or do I have to set up a separate account? Or how does that all work?
Yeah, so stay on the line and keep it open because I have a bunch of follow-up questions just to make sure I understand what you're asking so I can ask another question. One, you've had the trust for 5 years and you've had rental property in it and you've been collecting rent and paying your bills and living off the income. All that's been fine so far, correct?
That is correct.
Okay. Now you're at a point where you're saying And that's important for listeners to know, by the way, just so they can understand that, hey, I can have an irrevocable trust, have rental property in it, and live my life. And it's so important that someone like you sort of, justifies and verifies that can be done. Now, the next question, what if I want to sell it? Absolutely no problem in selling it. Now, I'm going to strongly suggest that you reach out to us when you're ready to do that, just because, some real estate attorneys don't understand the trusts and how to do it. But absolutely, you can sell it. Out will go the money. Out will go, let's say, rental property number one, and in will come the money. Make sure that the money gets deposited into a bank account in the name of the trust under the trust ID number, which I'm sure you already have, because if you had rental property, we would have gotten you an ID number when we created it. And so now the real estate is gone and the money's here. Now, you said a couple of things. One, well, geez, Todd, can I put the money in my IRA? No, right? Please don't do that, because the money that's in the trust is now just as protected as the house was when it was in the trust. And there is no new 5-year waiting period. So don't take the money out and put it in the IRA. That would be a bad idea, because remember, the IRA is not in your trust. It is outside the trust. It has to be outside the trust. Otherwise, there'd be a huge income tax if you were to, pull the money out of the IRA and put it into the trust. Now, if you don't like that approach, you mentioned the word 1031 exchange. Well, listeners don't know what that is, so let me tell them. A 1031 exchange is a way for you, Jim, or any of you listening, to say, I want to sell my property, my rental property, which might have a very low basis because I've been renting it. So let's say I bought it a long time ago, and so my cost basis is low. In addition to that, I've been renting it, so my basis has been reduced even further via depreciation deduction every year that I take on my income tax return. And if I sell it, I'm going to have a large capital gains tax. Well, I don't want to do that. So I want to defer that capital gain till later. Well, you can defer it by selling it and buying another property within 180 days. You have 180 days to buy the replacement property if you're going to do a delayed 1031 exchange. And then the replacement property takes on the basis of the property that you sold. So there's no gain recognized, and it's still built in, but you're not paying any taxes. But if you die owning it because you decided never to sell this replacement property that you bought, well, then you'll get a step up in basis inside this irrevocable trust. So, Jim, this trust is designed as a grantor trust for income tax purposes. So not only can you direct the sale and the purchase of another property, since you are treated as the owner for income tax purposes, you are also able to do a 1031 exchange. Just make sure the trust sells it and the trust buys the new property, and you will be able to defer the gain and then die owning the replacement property, and everything in the trust will get a new step up in basis, eliminating the built-in gain for the beneficiaries. So then they can sell the property and pay no capital gains tax. And depending on the size of your estate, there may be no estate taxes when you die either. So hopefully that gives you some indication of the flexibility and the benefits of doing this. And yes, you can do all of those things with the trust you have, and anybody else who's got an irrevocable trust, at least ones that we've prepared at Cushing and Dolan, can do these things as well. So long-winded answer, sorry, but there was a lot going on in that question. Hopefully that was helpful, but reach out. Don't sell it on your own. Please contact the office, and let's make sure we do it right. Folks, Jim, in this case, did advanced planning. So kudos to Jim. He's already gotten past the 5-year waiting period. You've heard all about that and all the things he can do. But you know what? There's people who don't do it. In the guide we're giving away this month, allows you to figure out how to protect assets last minute. Never as good, but better than nothing if you're faced with nursing home care. It's called long-term care planning for the procrastinator. It talks about the look-back period that we discussed here. It talks about annuities. How do you use these to protect money last minute? It talks about pooled trusts, how to work with a home, a rental property, a vacation home. They're all treated differently. IRAs, treated differently for married couples and single people. If you're faced with nursing home care, don't just write the check. So for folks who have done no planning, or folks who have done planning but still have assets outside of this irrevocable trust, there's something for everyone in this guide if you're faced with going in the nursing home. Call and get it, 866-848-5699 or legalexchangeshow.com. You can download it there. Again, 866-848-5699 or legalexchangeshow.com.
Todd, quick question for you. We're running out of time here, but what are the differences for planning for long-term care costs for a married couple versus an individual? What are some of the key takeaways between those two differences?
So you mean from a planning perspective or a cost
yes,
perspective?
A planning perspective between a married couple considerations versus a single person.
Yeah, and you know what? There's still the same irrevocable trust. So it's a great question for the amount of time we have left. It is still going to be an irrevocable trust. The difference is, one is obviously a single person trust and one is a married couple trust, and the operational differences are very much the same, but for tax purposes, they're a little different. Not for income tax purposes, but for estate tax purposes. So for income tax purposes, operational day-to-day, investing the money, living on the income, all of that is the same. Paying the income taxes is the same. But when you're married, the benefit there is the trust is designed to shelter assets for estate taxes as well. So you're able to do both nursing home planning and estate tax reduction by doubling the exemption to $4 million rather than just $2 million.
A lot of great information there. Thanks so much for the time, Todd. We really appreciate it. Good luck to your Steelers this weekend, and I hope you have a great rest of the week. Thanks so much for joining us, Todd.
Thank you. Always a pleasure.
This has been Ask Todd on the Financial Exchange Radio Network. Ask Todd with Todd Lutzke has been presented by Cushing & Dolan, serving Massachusetts and New England for more than 30 years, helping families with estate and tax planning, Medicaid planning, and probate law. Call 800-393-4001 or visit CushingDolan.com. The views expressed in this segment are solely those of Cushing & Dolan. Armstrong Advisory does not provide any legal or tax advice. Please consult with your legal or tax advisor on such matters. Cushing & Armstrong do not endorse each other and are not affiliated.
Taking a look around at markets, the Dow Jones off close to about 200 points. The S&P 500 really not moving a tremendous amount, only up about 5 points. The NASDAQ is rallying up close to about 0.5%. Taking a look around at some of the other economic indicators out there, we've got gold and silver moving pretty heavily again today, with gold off 1% at $4,500 an ounce, just shy of that 4,454. And we've got silver off about 5%. That's all the time that we have for the first hour here on the Financial Exchange, but stick with us right after this break. We have much, much more to cover in the second hour of the show right after this.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts has helped me and countless others adjust to civilian life through a variety of incredible programs. Through our local Veterans Assistance Program, we provide necessary services to veterans and their communities, such as food shopping, landscaping, and companionship, but we need your support. You can help by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
Are you over the age of 50? Want peace of mind and financial security for your family? Here's an important message to you from Senior Care USA. The average funeral now costs over $10,000. That leaves your loved ones the burden of paying your debts and funeral costs. Our plans start as low as $1 per day and will pay your family up to $30,000 to help pay for your funeral and other expenses. There are no medical exams. Your rates will never increase, and your plan cannot be canceled, regardless of your medical conditions, as long as you make your premium payments. Get up to $30,000 in final expense insurance. Call now for free information. Just answer a few simple questions and get approved right over the phone in just a few minutes. Call right now.
Call 800-378-3818. 800-378-3818. 800-378-3818. That's 800-378-3818.
This is the Money Matters Radio Network. WBNW 1120 AM and W275CM FM. Concord, Boston. The Money Matters Radio Network.
Here at the Massachusetts Department of Elementary and Secondary Education, we are committed to all students not only attending, but succeeding at school. Your presence is powerful. Share why you attend at doe.mass.edu.
Sponsored by the Massachusetts Department of Elementary and Secondary Education.
If you've been dreaming about a getaway that feels far away, but easy to get to, it's time to think about the U.S. Virgin Islands, America's Caribbean. This is a place where you can fall naturally in rhythm with the heartbeat of the islands. Enjoy crystal clear water and powder-soft beaches, world-class dining, sailing, and unforgettable sunsets. And here's the best part. Travel from New England is easy. The U.S. Virgin Islands are part of the United States, which means no passport required and no money to exchange. Just pack your bags and go. Spend your day snorkeling, sailing, hiking, or simply relaxing by the water, and your evenings enjoying local cuisine, live music, and warm island breezes. Explore St. Thomas, St. John, and St. Croix, 3 distinct islands, each with its own vibe, its own flavor, and its own way of helping you unplug and reset. Start planning your Caribbean escape today and visit usvi.com. Discover why the U.S. Virgin Islands are America's Caribbean paradise. For more information and to book your trip, head to visitusvi.com. That's visitusvi.com.
Hi, this is Chuck and Mike from the Armstrong Advisory Group. We have a guide available this month titled How to Apply for Social Security and Medicare. Mike, when we talk about actually determining when to apply, there are a few different factors that go into it, but I think really the specifics of, hey, if I want money at date X, when do I apply is kind of at the crux of this.
Oh, sure. And, oftentimes when you go to apply, they will actually tell you that they're backdating your application to the date that you apply. And so your first check might include a few checks of Social Security. You do have to be specific about when you request the actual start date. The good news is you do get a prorated increase for, we talk about this in years, but you do get a prorated increase for every month that you end up delaying your Social Security benefit, and you can be highly specific about when you actually want the income to start.
How does one go about determining what age they actually should start Social Security?
Yeah, look, every actuary out there will tell you this is all a life expectancy question and calculation. I'll tell you there's more to it than that, but it is highly specific to each individual. When am I retiring? When is my spouse retiring? When do I actually need this money to kick in? And what is my backup plan for covering my expenses if it doesn't kick in right away? So yes, life expectancy, a major factor in the decision, but there are other questions to be answered as well.
Our guide is titled How to Apply for Social Security and Medicare, and the ways that you can request it, there's 2 of them. First, you can call 800-393-4001. The second way, you can go to armstrongadvisory.com. Again, that phone number is 800-393-4001 or request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. From the elder law attorneys at Cushing & Dolan, here's something you need to hear. Most people think long-term care planning is something they'll get to someday, until suddenly someday is today. When a spouse or parent needs nursing home care and no planning was done, the costs can be overwhelming. Cushing & Dolan are elder law and estate planning attorneys who help New England families protect their homes, savings, and retirement, even when a health crisis comes out of nowhere. They've just released a new guide called Long-Term Care Planning for Procrastinators. It explains what options may still be available and what steps you should take before writing that first check to a nursing home. If you've been putting this off, or a loved one needs care right now, time matters. Call Cushing & Dolan today at 866-848-5699 to get your free guide. That's 866-848-5699. Or you can request it online by visiting LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Did you outgrow your timeshare and now you want out? But you can't. You can't sell it, and you can't get out of the contract. Imagine trying to get out of your mortgage. That's what a timeshare is. You can't just call up the bank and say, I don't want to pay it anymore. But we may be able to help you do just that. Listen, a timeshare maybe for you once was a great thing, but now you don't use it much. And they are not easy to get rid of. Plus, you do have to pay for it every month. Qualified timeshare owners can get out of their contract legally and permanently without ruining your credit or even filing bankruptcy. And imagine no more mortgage payment or fees. Call the Timeshare Exit Hotline qualification line now. It's free to learn more.
800-455-7967. 800-455-7967. 800-455-7967. That's 800-455-7967. Paid for by Timeshare Defense.
The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Paul Lane and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Paul Lane and Marc Fandetti.
Paul Lane, Marc Fandetti, Tucker Silva here with you as we kick off the 11 o'clock hour. Taking a look around at markets in relatively mixed territory, not a tremendous amount of movement either way. Dow Jones off about 175 points and the S&P's up about 8 points at the moment. The big focus for today's program as well as the rest of the week is the labor market. We're going to get several reports that is going to give us a pulse as to where the labor market stands at this point. Most notably on Friday morning, we will get the Bureau of Labor Statistics jobs report for the month of December, but we did get some important reports this morning, one of them being the JOLTS report, which is the United States Job Openings and Labor Turnover Survey, and that number came in lower than expected. This is for data for the month of November. The job openings in the United States fell 303,000 to 7.14 million in November of 2025. We also had a downwardly revised October number, which was previously about 7.6 million. That was revised down down to about 7.45 million. So again, indicating that there is not a tremendous amount of job openings out there. There has been a decline in that number, and it is certainly well off its peaks that we saw 3 years ago, where that number topped off at about 12 million there. We also had a labor report come out from ADP, which does a focus on the private employment market in terms of jobs added. We saw about 41,000 jobs that were added for the month of December, according to ADP. That was slightly below expectations of around mid 40,000s, but higher than the November numbers that we had seen, which was a loss of 29,000. So really what it comes down to, Mark, I highlighted some of those reports that we received this morning. We're going to get another labor report, I believe, tomorrow as well, with some jobless claims figures. But the headline is certainly Friday's report, where it seems as if that unemployment rate, the percentage, is probably going to be of most significant focus. For listeners out there, we sit at about 4.6% unemployment. The estimates have that the December jobs report will show that that has come down to 4.5%.
We care mostly because this will drive the Fed's estimate of how much slack there is in the labor market and how much demand they can risk creating, which is what they effectively do by printing money, lowering interest rates. It's meant to stimulate demand. You can think of the Fed as controlling, even though I'm being a little bit fast and loose here, the Fed controlling the demand side of the economy and structural forces controlling the supply side of the economy. Fed can't do anything about supply and shocks to supply. That's a different topic. So the question is the labor market merely normalizing? You pointed out that the ratio of job openings to unemployed people, which you can think of as a ratio of jobs demanded to people supplying jobs, that ratio is now about where it was before COVID.
Sub 1.
Before that period, though, which was a pretty hot economy, 2017, 2018, 2019, that was fairly hot. That ratio went up. Before that, the ratio was more like 0.75. So the question is, like, what's normal there?
Right.
And our values of that ratio, quotient, whatever you prefer. There's the thing on top, there's the thing on the bottom. You're dividing them. That's why we keep saying it's a ratio. What value is consistent with stable inflation? Is the labor market still hot? It doesn't seem to be still hot.
No,
it seems to be cooling down. It seems to be normalizing. Is it getting too cool? Is the Fed right to be stimulating the economy right now in the face of ongoing elevated inflation? Jury's going to be out on that for a while.
Where do we fall off the cliff and get to a point where it's too cold? It's too cold. I'm thinking of like the three little bears, the different bowls.
The Goldilocks
where it's
thing.
It's just too cold. Where does that point hit? And that's what the Federal Reserve has to continue to sort of juggle here: is what is the appropriate monetary policy to deal with all those factors. Inflation has sort of moved to the background, is not at the forefront of their focus. The labor market is, and so we'll get more information as the week progresses.
And you really do have to sympathize with the Fed. It's a very imprecise tool. Monetary policy has become the policy of choice over the past 30 years. Used to be fiscal policy. Fiscal policy just means spending or taxing, spending more or less or taxing more or less. Monetary policy is what the Fed does. That may sound like too simple a thing to have to even say, but I'll tell you right now, Jack Kennedy couldn't remember which was which when he was being briefed on these things after being elected president. So it's my point is, I don't think you could be too straightforward when you're trying to set the terms for a discussion like this. The Fed can only control the rate of money printing and the Fed funds target rate. And those have effects that operate with lags, like Milton Friedman said a very long time ago. Long lags and variable lags. Most economists still believe that. So not only are they flying blind, it'd be like deciding what to wear a year from now, just based on climate forecasts. Well, it could be 50 degrees today a year from now. It could be -2 degrees today. You just don't. Only within very broad contours can you
it's
say.
probably going to be cold in January. You won't need your beach weather.
But it could also be 50 degrees,
right.
I guess is my. So the economy could be slowing down. The rising unemployment rate and falling job openings could be indicative of something more alarming. Or it could just be normalization. We did, after all, just have 2 spectacular quarters of GDP growth, unsustainably high GDP growth, but spectacular nonetheless.
Will stocks crash in 2026? A fantastic headline here from the Wall Street Journal. I'm not sure if the actual content that belies the headline is as fantastic, but certainly is something that is always on investors' minds if we will see a crash in the upcoming year. And I think, Mark, you'll be helpful in maybe we're not sitting here as armchair quarterbacks who are going to say, well, I guess it would be not armchair because we're looking forward to predict, but we're not Nostradamus and going to predict what's going to happen in 2026. That is impossible to do, but really more giving the historical context in terms of when we have seen on average drawdowns of a certain percentage. When you look back at history, this piece goes into describe that they asked people to estimate the chance of a 30% drop in the S&P 500 over the course of the next 12 months. The average guess was that there was a 31% chance that we would see a 30% drop in the S&P. Whatever, the results are, that's I don't really care. You're just interviewing people from different firms on their projections. But really what the thing I would take away more is that if you look at history here, the chief U.S. economist at T.S. Lombard, Stephen Blitz, stated that the probability is more like 8 to 10%, or every 10 to 12 and a half years from a historical standpoint, you'll see that type of drop.
Yeah, I would have said more frequently, but it would have been off the top of my head. I would have said a little more frequently. It's possible that when you take the last 25 years, which have been an unusually, aside from the recession and COVID, and I know those are two big asides, but stock markets have become less. I'm going to get in trouble if I say this, not with anybody listening because it's too obscure. But if you have a PhD in finance, turn off your radio for a second because what I'm going to say would not impress you. Last 25 years have been a little bit less volatile than the prior period. I would have said a 1 in 5 chance of a 30% drawdown. But if you I'll just say the past several years have been unusually quiescent. So it makes it seem like those drawdowns are more rare than they actually are.
Quiescent.
Whew. Right? Is that a good? Does that capture
I hope
it?
the finance PhDs kept their radio on to hear a little bit
No,
of
they
that.
certainly know. They know that word. They wouldn't be impressed with that either.
There.
But I think a frequency approach is the right approach here because otherwise you're just pulling stuff out of an orifice. Just how often has it happened historically?
Yep.
That most of the time annually, over 70% of the time, or roughly 70% of the time, stocks go up. So that should probably be it's a loaded coin. 7 out of 10 times you flip heads, and heads being good here. Maybe that's the right way to answer that question. If you're a financial professional, what would you tell a client?
The best way to encapsulate this whole piece is the end of this Wall Street Journal piece where they quote star fund manager Peter Lynch, where he has observed that far more money has been lost by investors trying to anticipate corrections or trying to time the market than has been lost in the corrections themselves. I feel like that is a pretty good way to sum it up, is this idea of trying to time or predict a crash is often not worth it. It's really...
That's baloney, Lynch. Wait a second. When we've had 50% crashes when stocks started with a market cap of $20 trillion. You can't tell me that people mistiming market cycles has resulted in bigger. No. That cannot.
Mistiming?
Lynch, yeah, mistiming. Didn't I say that?
No.
Right?
I think what he's saying...
Lynch, I think he's quotable, but he's full of it on this one. There's no way market timing has cost more people than the actual drawdowns cost everybody. Think about that.
Oh, yes. Oh, yeah.
Right? Think about that for a second.
Well, because you're picking on the people who sold out, right?
Which
yeah.
It's a few.
Yeah.
What could that be? $1 trillion out of current market cap of 50? But if we have a 50% drawdown, 25 to 30 trillion gets wiped out. Think about the magnitudes is what I'm saying.
The magnitude, yes, but I think you understand the point is more so those people lost out.
No, I get
more
it's a
than,
sensational point. You remember it.
From a percentage standpoint.
It's also good advice. It's good advice, but the underlying argument is baloney if you dig into it for a second.
Oh, you're tough. You're tough on old Peter Lynch here.
No, I love him, and I think he's doing the right thing. Just be a good salesman and tell people to stay invested. But actually, there might be a better way to make that point that's more numerically correct.
We'll see what 2026 brings. We're going to take a quick break here on the Financial Exchange. When we come back, we're going to be talking with Ted Rossman from Bankrate.com, and he's going to be going over the 2026 interest rate forecast. That's coming up right after this break on the Financial Exchange.
Hear the Financial Exchange every day from 11 to noon on SiriusXM's Business Radio Channel 132. Keep it here for the latest business and financial news and the trends on Wall Street. The Financial Exchange is now live on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network. This is a message for families who've been putting off their estate planning from the elder law attorneys at Cushing & Dolan. One of the biggest myths about long-term care is that if you didn't plan 5 years ahead, you're out of options. That's simply not true. When a health crisis hits and a loved one needs nursing home care, many families panic and start writing checks for care that may cost over $10,000 a month. The reality is, there may still be meaningful legal options available, even when planning starts late. Cushing & Dolan have just released a new guide called Long-Term Care Planning for Procrastinators. It breaks down what the 5-year look-back really means and what steps can still be considered before making decisions that can be incredibly costly. If you're worried about protecting your family and securing your financial future, call Cushing & Dolan at 866-848-5699 to get your free guide today. That's 866-848-5699 or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. If you've been dreaming about a getaway that feels far away but easy to get to, it's time to think about the U.S. Virgin Islands, America's Caribbean. This is a place where you can fall naturally in rhythm with the heartbeat of the islands. Enjoy crystal clear water and powder-soft beaches, world-class dining, sailing, and unforgettable sunsets. And here's the best part. Travel from New England is easy. The U.S. Virgin Islands are part of the United States, which means no passport required and no money to exchange. Just pack your bags and go. Spend your day snorkeling, sailing, hiking, or simply relaxing by the water, and your evenings enjoying local cuisine, live music, and warm island breezes. Explore St. Thomas, St. John, and St. Croix, 3 distinct islands, each with its own vibe, its own flavor, and its own way of helping you unplug and reset. Start planning your Caribbean escape today and visit usvi.com. Discover why the U.S. Virgin Islands are America's Caribbean paradise. For more information and to book your trip, head to visitusvi.com. That's visitusvi.com.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. Retirement comes with a lot of exciting freedom, but also with some permanent decisions. 2 of the most important ones are when to file for Social Security and how to set up your Medicare coverage. Claim Social Security too early and your monthly check may be permanently reduced. Missing Medicare enrollment deadlines might mean significant penalties and gaps in coverage. We have a new guide available called How to Apply for Social Security and Medicare. It breaks down when you can apply, what information you'll need, and how these decisions fit into a smart, coordinated retirement plan. Get your copy today by calling 800-393-4001. That's 800-393-4001, or you can request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Cardiovascular disease is the #1 killer of women,
taking the lives of 1 in 3.
That's more than all forms of cancer combined.
For too long, heart disease and stroke have taken the lives of the women we love.
But we're not giving up because we have something better,
stronger, more powerful.
We have each other.
When we come together and go red,
the more power we have against our greatest health threat.
Visit goredforwomen.org today to learn more.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, the grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
Find daily interviews and full shows of the Financial Exchange on our YouTube page. Subscribe to our page and get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network.
Subscribe now to our YouTube page where you'll find daily interviews and full shows of the Financial Exchange. You'll get caught up on anything and everything you might have missed right here on the Financial Exchange Radio Network. Just search the Financial Exchange on YouTube and hit that subscribe button.
As promised, we are joined by Ted Rossman from Bankrate to give us a preview of 2026 in terms of an interest rate forecast. Ted, thanks so much for joining us today. Appreciate it.
Good to be here. Thank you.
Ted, always a very difficult challenge. This time of year, you have a lot of people sort of pinned down to make projections on what the market's going to do, what interest rates are going to do, and you acknowledge that here in the piece that it is challenging, but you look at it from a couple different realms. So let's start first with mortgage rates. What are you seeing in terms of a forecasting from the 30-year fixed mortgage heading into 2026, keeping in mind that all of us should take these predictions with a grain of salt, right, as it's very hard to do this accurately?
Right now, the average 30-year fixed mortgage rate is 6.25%. It hasn't been below 6% since the summer of 2022. I believe we will soon go below 6%. I think this year we're going to see rates move sometimes a little below 6, sometimes a little over 6, maybe trading somewhere in a 5.5 to 6.5% range. Mortgage rates tend to be a bit more volatile than other financial products because they're tracking 10-year treasuries. So they're kind of at the whims of the markets here. There may be some times that we get a bit of a growth scare. Rates may go lower. We also may have times that inflation's rearing its head or economic factors are pointing to somewhat higher rates. I believe the Fed's going to cut 3 times this year. I'm forecasting 3 quarter-point cuts from the Fed. That doesn't directly influence mortgage rates as much as it does some other products. So I would say kind of in general, a slow drift downward for mortgage rates. It could be volatile though, sometimes higher, sometimes lower, but around 6.
That's an important point to make, and maybe we could just examine that a little bit further just for listeners, is that, you know, when the Federal Reserve is talking about cutting interest rates, they're cutting the shorter end of the curve. And from what I've read, Ted, and you can correct me if I'm wrong, there's not a direct, of course, one-to-one correlation that, hey, they cut rates, all of a sudden mortgage rates go down, because as you mentioned, they are tethered more closely to the U.S. 10-year Treasury. But is there some sort of impact that the Federal Reserve cutting interest rates can have on that longer end?
Some impact, definitely. Not as direct as some other products like credit card rates, home equity lines of credit. Those move pretty much directly in line with the Fed. Like if the Fed cuts a quarter point, your credit card rate is going to go down by a quarter point soon. It's not as direct for mortgage rates. Certainly, the Fed is one of the inputs that investors are weighing when they set 10-year Treasury rates. But one of the interesting things about this year, and one of the things that makes this year so uncertain, is what happens with the new Fed chair. Jerome Powell's term ends in May. We know the president's pushing for someone who's going to substantially lower rates. If the Fed moves too fast, though, and lowers short-term rates too much too fast, it could actually give us a head fake with long-term rates. Things like long-term treasuries, mortgage rates, they could actually go up in a scenario where the Fed cuts too much too fast. It stokes inflation. It stokes fears that the Fed may not be as independent from political pressure as it used to be. So we want rates to be falling for the right reason, namely that inflation's coming down and the economy is relatively stable. So that's one of the kind of wild card factors that we need to watch this year.
You mentioned some of the areas that would be more impacted by interest rate cuts: home equity lines of credit, money markets, auto loans. Any commentary that you have on any of those three? You pick where they would go with the premise that, hey, perhaps you're projecting 3 interest rate cuts, what direction it looks like for any of those 3 categories heading into 2026 here.
I believe that rate cuts will have the biggest influence on the housing market. So we already talked about mortgage rates. Rates below 6 could stimulate some buying activity.
Right.
Falling rates for home equity borrowing are beneficial for people that are maybe looking to fund some home improvements or maybe looking to consolidate debt or use that equity for other purposes. People are sitting on record amounts of equity. And these rates, while they're not as low as they were a few years ago, you're not getting a 4% home equity line of credit right now. The fact that you could be looking at one in the 6s maybe, especially if you have good credit, or maybe around 7% on average, I mean, that actually is spurring some activity. You contrast that with something like a credit card where the rates are high and they're going to stay high. Yep. The average credit card charges almost 20%. If that falls to 19%, people are hardly going to notice. Auto loans are another area where we're facing high affordability challenges. It's actually not so much of a rate problem with cars as it is that prices are high, insurance costs are high, repairs, maintenance. Auto loan delinquencies are at a 15-year high, but it's not really loan rates that are to blame. It's more some of these other factors. So when we talk about falling rates this year, I would say the biggest impacts are likely to be on mortgage buyers and refinancers and somebody seeking a home equity loan or line of credit.
Great information. Ted Rossman from Bankrate doing a 2026 interest rate preview with us. Ted, thanks so much for the time. Really appreciate it.
No problem. Thank you.
Taking a look around here at markets, again, still relatively in sort of mixed territory here. There really hasn't been a tremendous amount of movement from the major indices here as we continue to digest the U.S. and Venezuela and sort of what that means from a political standpoint. Taking a look around at some of the major stocks making headlines. Intel is up over 8% today, and you've got the NASDAQ in general rallying about 90 points at the moment, up about 0.4%. Oil, that certainly has been in the headlines quite a bit recently, has slipped down a little bit. As we talked about earlier in the program, we are going to receive an increased supply of oil from Venezuela. I believe it was it 50 million barrels, Mark, that they had said that were coming our way. So not a direct cause of that, but we do have oil, West Texas Intermediate down at about $56 a barrel. It's off about 1.33% today. And the metals continue to make headlines in terms of their volatility, with gold off close to a full percent and silver is off about 5%. We'll have more of this here right after this break with Wall Street Watch, and we'll also be doing trivia right after this break on the Financial Exchange. Stick with us.
Bringing the latest financial news straight to your radio every day. It's the Financial Exchange on the Financial Exchange Radio Network.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts has helped me and countless others adjust to civilian life through a variety of incredible programs. Through our local Veterans Assistance Program, we provide necessary services to veterans and their communities, such as food shopping, landscaping, and companionship, but we need your support. You can help by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
Did you outgrow your timeshare and now you want out? But you can't. You can't sell it, and you can't get out of the contract. Imagine trying to get out of your mortgage. That's what a timeshare is. You can't just call up the bank and say, I don't want to pay it anymore. But we may be able to help you do just that. Listen, a timeshare maybe for you once was a great thing, but now you don't use it much. And they are not easy to get rid of. Plus, you do have to pay for it every month. Qualified timeshare owners can get out of their contract legally and permanently without ruining your credit or even filing bankruptcy. And imagine no more mortgage payment or fees. Call the Timeshare Exit Hotline qualification line now. It's free to learn more.
800-455-7967. 800-455-7967. 800-455-7967. That's 800-455-7967. Paid for by Timeshare Defense.
Social Security and Medicare are oftentimes lumped together, but may be handled separately. And depending on your strategy, they could shape your entire retirement plan. Hi, this is Mike Armstrong from the Armstrong Advisory Group. Choosing when to start Social Security has many effects, including determining the amount of guaranteed income you receive each month. Medicare decisions go beyond coverage as they can impact premiums, out-of-pocket costs, and access to providers throughout retirement. Our new guide is called How to Apply for Social Security and Medicare. It will help you learn how these decisions may fit together and how to take the right steps at the right time to build a secure retirement plan. Call us at 800-393-4001 to get your copy of How to Apply for Social Security and Medicare. That's 800-393-4001. 877-829-0001, or you can request it online from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Tucker Silva, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange legal quick tip of the day. And today we're talking about last-minute nursing home lessons that can help save your assets. Todd, more and more people are providing in-home care for their loved ones. Is there anything a care provider can do that would be beneficial to them or the family?
So if you're already providing care for an individual at home, and more people, as you said, are in fact doing that, the best thing to do is to set up a personal care contract, right? A personal care contract is something that allows you to get paid by your family member, and as long as you report it on your income tax return and prepare a personal care contract, make sure you get an elder law lawyer to help you prepare that contract because it's got to be done right. But if you do those two things, get the contract and provide the care and put the income on your income tax return, the transfers are non-disqualifying transfers. So even if you don't make the 5 years, those dollars that you're moving will not need to be returned and they will be protected. Also, while you're doing that, set up the trust and get the 5-year clock started. Put some assets in because you just never know if you're going to make it or not, and you would always want to have that 5-year clock running to protect your assets.
Cushing & Dolan has written a brand new guide, especially for those of you who have put off doing your planning and are now faced with a last-minute nursing home situation. Request this brand new guide from Cushing & Dolan. It's called Long-Term Care Planning for Procrastinators. You can call 866-848-5699, or you can simply request it from their website, legalexchangeshow.com. Once again, simply call 866-848-5699, or get it from their website at legalexchangeshow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch, a complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Markets are mixed as investors react to the JOLTS report posted earlier this morning, where the number of available positions decreased to 7.15 million in November from a downwardly revised 7.45 million in the prior month, marking more than 1 year low. Right now, the Dow is off by about 1/3% or 156 points lower. S&P 500 is up only 5 points. NASDAQ up over 0.4% or 99 points higher. Russell 2000 is off by about 0.5%. 10-year Treasury yield down 3 basis points at 4.142%, and crude oil down just over 1% lower, trading at $56.50 a barrel. The Financial Times reported that Chevron and Quantum Capital are planning a bid to buy Lukoil's international assets. Chevron stock is edging higher in that news. Meanwhile, Warner Brothers told shareholders to reject Paramount's amended hostile bid for the company, saying its existing deal with Netflix is stronger. Warner stock is up modestly, and Intel stock is rallying 8% after the chipmaker unveiled next-gen AI PC processors at the Consumer Electronics Show in Las Vegas. I'm Tucker Silva, and that is Wall Street Watch, and we are going to do trivia now. We haven't done that yet. So here we go. On this day in 2019, Amazon surpassed Microsoft to become the most valuable company in the world at the time. Amazon was valued at $797 billion. Today, both companies are well into the trillion-dollar company list. So, trivia question today. How many U.S.-based companies are worth $1 trillion? Once again, how many U.S.-based companies are worth $1 trillion? Be the third person today to text us at 617-362-1385 with the correct answer, along with the keyword trivia, and you win a Financial Exchange Show t-shirt. Once again, the third correct response to text us to the number 617-362-1385 with the correct answer, along with the keyword trivia, will win that t-shirt. See complete contest rules at financialexchangeshow.com.
1 trillion or greater, I guess, right? Would be
yeah.
Okay.
Also, as of what, 12/31,
probably
2020. Tucker's going to shut.
They're looking.
He's going to shut.
No more questions about trivia.
Yeah.
Well, it's trades these, so I'm kind of directing this to him. As of 12/31/2025,
Sure.
or as of
No soup for
I
you.
mean, if you're Googling that, which most people, I would do that to answer this question. It might
Mark,
be as of
have
12
some integrity.
It might have some
Please.
integrity.
For the sanctity of trivia, it's supposed to be off the top of your dome. No Googling.
I couldn't do it. And also, I'd need to know as of when, because market cap changes. But
we'll write our guests down. I think I can get it.
It's a fluid concept here at the Financial Exchange.
We're talking about
time is a fluid concept for Ben Kitchen.
We were talking about U.S. markets, but emerging markets have been in tremendous focus. Last year, rallying upwards of 34%, nearly doubling the return of the S&P 500, breaking a trend where the emerging market category had well underperformed U.S. markets for at least a decade.
For what feels like 20 years.
Yeah, it feels like 20 years, but I can say
investor.
with pretty sound certainty for the last decade, of course. This is an area where typically if you talk to people about portfolio construction, whether it be within a 401k or an asset allocating in general, there has been often this idea that you need to have global diversification and have a slug of your portfolio, say 20-25% as a rough figure, into emerging markets and international equities.
Yeah, international. Yeah,
there is counter arguments to be made that with some of these U.S. companies that you're dealing with within the S&P 500, that they do have global exposure, that they don't just sell their products domestically.
Like half,
they sell them. Half of their products
sales,
are sold.
I think,
come from overseas. So you are getting exposure there. In terms of the reasons for the strong performance last year, one of them is the weakening dollar. We did see the U.S. dollar weaken relative to foreign currencies last year. You also had the confluence of areas like semiconductors. In particular, if you look at semiconductor manufacturing, Taiwan Semiconductor is a company that has significant market share there, and their stock has done tremendously well. They represent a very heavy percentage of emerging market funds out there. That was an area that benefited. Commodities and materials had a great year too, and that can loop in some countries like Brazil and Peru and others that are a little bit more heavy in sort of the material side of things. But Mark, your thoughts just on emerging market performance and perhaps some drivers for growth for the 2026 year.
That's a big topic. We could talk about EM growth, which has been disappointing.
Yep.
EM company-based profitability is a slightly different story. Historically, the argument for any asset class, which is a fancy way of saying something that's investable. So large cap stocks are an asset class. And they also have to be distinct in a sort of a correlation sense. The correlation's not perfect, or it shouldn't be, for something to be a distinct asset class. So large cap stocks, US, that's the S&P 500 more or less. Medium-sized company stocks, the S&P 400, or the Russell mid-cap 2500. I think it's 2500. International stocks are a distinct asset class. And then within an international, there's developed, which is Europe and developed Asia. And then there's emerging. So overall, U.S. stocks are about 70% now of global market capitalization. That's just the total value of the shares of all U.S. companies, which means 30 cents out of every dollar invested in equities worldwide is invested in non-U.S. companies. So that's an important asset class because it's big. This is why if you have a target date fund in your 401k, one of those kind of set it and forget it suckers that rebalances and reallocates automatically, you'll see 10 to 30%, I should say, maybe 20 being an average in foreign stocks.
Yep.
It's an important asset class. So last year, gangbusters for EM, emerging markets, that is. We've seen this story play out before in the early 2000s when EM returns were consistently spectacular, drew a lot of people in, and they've more or less been disappointing ever since.
Really have, yeah.
Part of the reason for that is that I gave a general portfolio construction, to use your phrase, rationale for EM, which is it's out there and it's investable and it's imperfectly correlated with U.S. assets, so it should be considered. That is an uncontroversial statement. You'll find it in any finance textbook. The story advanced by proponents of EM, people that manage EM money and want your money, is that growth potential is higher. That for demographic reasons,
right.
And because for a long time these were basket cases by rule of law standards, and they've since gotten their act together. But that higher growth is not materialized. GDP per capita in Mexico, Argentina, and other countries in this hemisphere come to mind. They've had flat per capita GDP for like 10 years.
Right. The valuation is a big part of the story, too, where right now you have the emerging market equities trading at nearly a 40% discount to U.S. peers, one of their lowest forward PE differentials in more than a decade. Again, price to earnings ratio is what they're talking about there. That has been sold. If you're someone who is in the emerging markets space, that has been a big sale. So certainly it'll be interesting to see how emerging markets fares for 2026.
If you've been dreaming about a getaway that feels far away but easy to get to, it's time to think about the U.S. Virgin Islands, America's Caribbean. This is a place where you can fall naturally in rhythm with the heartbeat of the islands. Enjoy crystal clear water and powder soft beaches, world-class dining, sailing, and unforgettable sunsets. And here's the best part. Travel from New England is easy. The U.S. Virgin Islands are part of the United States, which means no passport required and no money to exchange. Just pack your bags and go. Spend your days snorkeling, sailing, hiking, or simply relaxing by the water, and your evenings enjoying local cuisine, live music, and warm island breezes. Explore St. Thomas, St. John, and St. Croix, 3 distinct islands, each with its own vibe, its own flavor, and its own way of helping you unplug and reset. Start planning your Caribbean escape today at visitusvi.com. Discover why the U.S. Virgin Islands are America's Caribbean paradise. For more information and to book your trip, head to visitusvi.com. That's visitusvi.com.
Final word on the emerging market value.
Yeah, the valuation differential was historically chalked up to the U.S., of course, being the most stable in addition to largest and consistently among the fastest growing economies in the world, which is remarkable given our size.
Yeah.
The reason why commentators and some economists wring their hands a lot about the deficit and about monetary policy independence, the deficit continues to spiral out of the debt continues to spiral out of control. Federal deficit was actually down a little bit, like 1% last year.
1.9 trillion?
Yeah, something like that. But it was actually down because of tariffs. It was actually down a little bit. So, but nevertheless, still like hemorrhaging red ink. So I probably shouldn't make too much of that. But the reason why we talk so much about monetary policy independence, like you don't want a president dictating what interest rates should be, because any president would want lower interest rates. They don't want to crush the economy.
They care about their 4-year term, not the long-term health of the economy.
Only human and natural. The reason economists sound the alarm about deficits and monetary policy independence and other things, consistency in administering the laws, is that those are the factors that have created the environment which have arguably allowed valuations to rise to the level that they've risen to in the United States. Many people are writing about this sort of equalization now of standards and norms as policy in the U.S. becomes less stable. You could say you love it. You want Trump to run monetary policy. You want him to buy public. You want him to take shares in companies. You want him to reward friends and punish enemies. You love that style of leadership. That's not what I'm talking about here. I'm just talking about stability. You can't argue that there's less of it now than there was. Can we have the same valuation advantage relative to other economies if they are catching up to us in terms of, I'll just say, governance standards and institutional quality? That's an important question for a long-term investor estimating capital market returns. It's not a question we're going to be able to resolve here today.
Yeah, definitely an interesting question to pose. We're going to take a break here on the Financial Exchange. When we come back, a little bit of stock roulette right after this break.
The Financial Exchange Show podcast drops every day on Apple, Spotify, and iHeartRadio. Hit that subscribe button and leave us a 5-star review. You're listening to the Financial Exchange Radio Network.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. Retirement comes with a lot of exciting freedom, but also with some permanent decisions. 2 of the most important ones are when to file for Social Security and how to set up your Medicare coverage. Claim Social Security too early and your monthly check may be permanently reduced. Missing Medicare enrollment deadlines might mean significant penalties and gaps in coverage. We have a new guide available called How to Apply for Social Security and Medicare. It breaks down when you can apply, what information you'll need, and how these decisions fit into a smart, coordinated retirement plan. Get your copy today by calling 800-393-4001. That's 800-393-4001, or you can request the guide online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. If you've been dreaming about a getaway that feels far away, but easy to get to, it's time to think about the U.S. Virgin Islands, America's Caribbean. This is a place where you can fall naturally in rhythm with the heartbeat of the islands. Enjoy crystal clear water and powder-soft beaches, world-class dining, sailing, and unforgettable sunsets. And here's the best part. Travel from New England is easy. The U.S. Virgin Islands are part of the United States, which means no passport required and no money to exchange. Just pack your bags and go. Spend your day snorkeling, sailing, hiking, or simply relaxing by the water, and your evenings enjoying local cuisine, live music, and warm island breezes. Explore St. Thomas, St. John, and St. Croix, 3 distinct islands, each with its own vibe, its own flavor, and its own way of helping you unplug and reset. Start planning your Caribbean escape today and visit usvi.com. Discover why the U.S. Virgin Islands are America's Caribbean paradise. For more information and to book your trip, head to visitusvi.com. That's visitusvi.com. When a loved one needs a nursing home, decisions need to be made quickly. If you haven't started planning yet, get Cushing & Dolan's new guide called Long-Term Care Planning for Procrastinators. In it, you'll learn how to make smart decisions and avoid unnecessary expenses. Call 866-848-5699 to get your free guide today. That's 866-848-5699. Or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, I'm Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts provides thousands of hours of voluntary services at our VA medical centers and soldiers' homes and is the only DAV department in the country to lead a veterans housing initiative for both single veterans and those with families. These programs are critical to serving our veterans in their time of need. You can help our great American heroes by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
Cardiovascular disease is the #1 killer of women,
taking the lives of 1 in 3.
That's more than all forms of cancer combined.
For too long, heart disease and stroke have taken the lives of the women we love.
But we're not giving up because we have something better,
stronger, more powerful.
We have each other.
When we come together and go red,
the more power we have against our greatest health threat.
Visit goredforwomen.org today to learn more.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
The Financial Exchange is live on SiriusXM's Business Radio Channel 132, weekdays from 11 to noon. Get the latest business and financial news from across the country and around the world, and keep up to date on how it might affect your wallet. That's the Financial Exchange, weekdays from 11 to noon on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network.
The Financial Exchange is incredibly proud to be a partner of the Disabled American Veterans Department of Massachusetts. Planning is well underway for the 2026 DAV 5K. The event sold out in record time last year, so head to dav5k.boston for all the information about how you can participate this November or make a donation to support our great American heroes. Your gifts help fund free rides to medical appointments for veterans in the nation's first DAV-led housing initiative, providing homes for single veterans and veteran families. Go to dav5k.boston and make your donation today. That's dav5k.boston. Trivia question in the previous segment was, how many U.S.-based companies are worth $1 trillion? That would be 9. NVIDIA, Apple, Microsoft, Alphabet, Amazon, Meta, Berkshire Hathaway, Broadcom, and Tesla, all worth $1 trillion. Ben from Belmont, New Hampshire is our winner today, taking home a Financial Exchange Show t-shirt. Congrats to Ben. And we play trivia every day here on the Financial Exchange. See complete contest rules at financialexchangeshow.com.
Time for a little bit of stock roulette. Mark, I will let you lead off.
All right, I'm going to try to provoke you here.
Okay. It's from the AI battle,
From the Financial Times. AI will free households from chores and boost hidden productivity, says OpenAI. You've seen the story.
Seen the story.
Doesn't this seem a little... So the crux of the argument, let me see if I can summarize it in a couple sentences, is this AI may not show up in the data anytime soon, but you're going to have so much more free time. We got to find a way to... Your well-being is going to be so much higher because of AI. We at OpenAI are going to find a way to measure that. GDP's not going to do it. Productivity may not show up. I'm exaggerating a little bit here. This study was done by Aaron Chatterjee. I think I'm pronouncing his last name right. He's a Berkeley PhD, so he knows how to do good research. But doesn't this seem a little self-serving and desperate to you?
Yes, it is.
But But you have a different feeling on it. So just
on this one in particular. Well, the debate you and I always get into, and I was thinking about it as you had sent me a piece last week when we had done the show, basically stating what you just alluded to there is that in the data, and I'm not disagreeing with it, we haven't seen any significant economic data that points to that AI is leading to a widespread transformation in productivity or earnings growth for many companies out there that are trying to incorporate it. And so heading into 2026, that is the big focus, right? Is are we going to see instances? And I could point to cherry picking 2 or 3 of them to combat that argument, but you could come back at me and say, well, Paul, those are 2 or 3 instances. The broader data set isn't pointing to that. And so it becomes the argument of, I'm taking from the stance of, as a long-term equity investor, I am optimistic about the technology's potential because believing in being long U.S. stocks or internet stocks in general, we need this technology to provide productivity gains and earnings enhancement.
I mean, I'm a bullish long-term as well on the economy and, of course, on equities. But why do we need this particularly to pay off? Maybe it'll be something. I'm not saying I don't think it will, by the way.
Right.
There's probably a 70% chance that it is widespread and transformative as its proponents. I'm not sure that existing players will be the ones to benefit from that. But I don't doubt that it'll be pervasive. But why is it so existential?
It's not existential, but if that is what it's the dark horse to bet on, right? If you're hoping for future gains for the market, is if this technology can be truly transformative and help all sorts of companies, increase efficiency, reduce costs, generate more profitability. So
or it sucks up a lot of investment that goes nowhere that could have been used to, I don't know, cure cancer or power.
Well, hopefully this is supposed
invest
to be
in more nuclear power plants, which thank God we're moving ahead with. Or I worry a little bit about it diverting too much from other possible growth engines. Are you putting all your eggs in one basket?
Putting all your eggs in one basket is a reasonable argument. There's going to be a significant amount of investment, but could it be the case? It's always lazy to use kind of the broadband parallels of the late 90s, but that does I keep coming back to that example of overinvestment for sure, but then had companies benefit significantly from that overinvestment.
But the productivity, the broader economic benefits petered out after arguably, well, the productivity benefits ended in 2004. That's well documented. Now, you could say economic growth would have been even slower. This century, economic growth has been about 2% GDP per capita, a little less, that is per head. Overall GDP growth about 2%, about 2/3 as fast as the prior century. I'm obviously not saying it's because of that bubble. Maybe without those investments, growth would have been even slower. We can't run that alternative history type experiment.
Yeah, I'm just going back to your piece of like, hey, where would you divert the capital to? And you had mentioned nuclear and some other areas to invest in.
Nuclear seems to be being driven by AI data center needs.
I could make the argument that there was a piece the other day that within healthcare, there is a tremendous amount of incorporation of artificial intelligence, and maybe from a diagnostic standpoint, that helps people sort of figure out more of the. I thought Tucker was giving me the.
I think he was telling me to pat my eyebrows down. I think my eyebrows were brushing.
That's a me
on
problem. I have to brush my eyebrows because they're
he was
so
telling
huge.
me to nix it, but there's been a lot of. I was like, what's so controversial about investing in artificial intelligence?
Because they're giant eyebrows.
Hey, let's not. Nothing wrong with giant eyebrows.
No.
I guess we
I
said.
I got you beat.
So I guess we're not so different after all. Is the bottom line? You're still optimistic on?
Oh yeah, I think it's going to be absolutely transformative.
Okay.
I just don't think it's going to send economic potential GDP from about 2 where it is today to 3. I mean, maybe, but if it does that, it's going to suck investment from other places. Don't forget, you can't just change one thing and not change others.
That's all the time that Mark and I have for this debate, for this edition of the Financial Exchange, but we'll be back at it tomorrow at 10 a.m. to discuss more on the economy. Thanks so much for joining us.